Affirm, that is the big winner. It's the best performing tech name, at least among those with a market cap above $5 billion. It's up 430% for the year. And guys, this has been an epic turnaround story for that lender. Affirm had lost about 90% of its value back in 2022. Part of the story is tech's comeback, the NASDAQ having its biggest gain in decades. As you guys have been talking about, unprofitable tech names had been some of the most shunned stocks as the Fed started hiking rates. Now the Fed cuts are on the horizon. Investors are turning back to some of the riskier, money-losing growth stories like Affirm. It's also a way for investors to play that buy now, pay later surge. Adobe estimates that these types of installment payments were up about 15% for the year and then 40% or so, more than 40% just on Black Friday weekend. Then there's the short interest factor. Affirm is one of the most highly shorted names out there. About 18% of the float sold short, adding to some of the volatility short covering this year has sparked some of Affirm's biggest rallies. It has also become a favorite among retail investors. So almost a quarter of its trading volume, about 17% in December, came from individual investors. That's according to VandaTrack. All of this is giving Affirm's top investors some reasons to celebrate heading into the new year. One of those is actually Shopify, which owns 4% of Affirm. That stake now worth over $500 million, according to FactSet. And then you've got Peter Thiel's Founders Fund. It's the firm's second largest individual shareholder there. And then, of course, the company's founder and CEO, Max Levchin, ringing in the new year with a company stake worth $1.4 billion. That's up from about $250 million just a year ago. While the lending picture is looking a bit better and delinquencies have stayed in check for Affirm, the stock has seen a series of downgrades, including Morgan Stanley recently saying that the valuation is now unsustainable for Affirm. It is not the only money-losing, highly shorted name on this list. Really having a banner year. You've got Coinbase. That's the second best performer thanks to the Bitcoin rebound. That name's up 426%. So neck and neck there for those two guys. Back to you.
Hey, I was just going to say, and Bob and Kate, that you use the word unprofitable, but what changed is a lot of these unprofitable tech companies have found a little bit of religion on profitability, right? They went through 2021 and then 2022 on the higher rate story, got punished brutally, and their finances have improved a lot, haven't they, Kate?
There's been a lot of belt tightening, so you've seen things like layoffs in terms of bringing the cost down when it comes to stock-based compensation. That's been echoing through Silicon Valley. Tech companies, I mentioned Shopify, that's another name that's been able to rein in cost. Coinbase, too. You've heard it on all of these earnings calls, at least with some of these names, that they've talked about the discipline, cost discipline, and really tried to echo that for investors and say, going forward, we're going to make sure we're cutting costs. And you've seen it. Margins have gotten better. They've been able to keep that in line. It's a story that investors like. And then also you've got the tailwind of lower interest rates. But that's absolutely part of it here, that they've found some religion and said, all right, enough with the growth at all costs. We're going to try and tighten our belts here. And that seems to be working.